Let me get you to jump in here. It says in my notes, stocks are likely selling off because of the inflation element of the GDP report. Certainly smelled of stagflation with weaker growth and hotter inflation. That's exactly the opposite, it seems to me, of what Greg is saying.
Yeah, and I think Greg makes a great point. There is a twist to the story around stagflation. In addition to what Greg mentioned, I'd also point to initial jobless claims this morning coming in at 207,000. We look at an unemployment rate that remains below 4% today. So the labor market's incredibly strong right now. I think the markets are really spooked by this idea that it's taking a long time to get back down to the Fed's 2% inflation target here. From a market perspective, we are seeing a potential rotation play out right now into more cyclical areas of the market, energy stocks, value stocks that really were not caught up in that Fed pivot momentum trade that resulted in massive multiple expansion, particularly on the technology side. So I think investors should consider leaning into those areas of the market because it does look like we're in a period where the path to inflation here is pretty bumpy in terms of getting it back down.
Is the market, Emily, overreacting to these numbers?
Potentially. First of all, when you get GDP reports, they don't usually move markets this much. It's a month-old report. It's heavily subject to revisions, and we'll find out what those are later. But I think markets are ultra sensitive to the inflation backdrop today. So as the day's gone on and great economists like Greg and others have really dug into the numbers, it turns out that growth really isn't all that bad. I think the challenge now is how the market's going to digest this new environment where cuts are being taken out. And that's really the challenge as bonds go up, yields, stocks fall, those correlations increase. Where are investors to turn in this difficult macro backdrop?
So, Steve, tie this all up for us. If you would make a little bit of a reference to consumer spending, 2.5%, which was slower than previous quarter.
Yeah.
But also the idea of where this puts the Fed. Because on the one hand, you have a maybe slower than anticipated economy, which would argue for maybe more a stimulative approach on the part of the Fed. And on the other hand, you have potentially, though Greg kind of disputes this a bit, a potentially higher inflation number, which would say you got to stay higher for longer.
Yeah. So, Tyler, I brought along a chart. Guys in the back, we have a chart on real domestic final purchases that should sort of ease concerns about the growth number. What this number does is it takes out, there it is. Now, it's really hard to see in that right-hand most number bar there a dramatic slowing of the economy. What you see there is an easing really from 2 quarters before it that were the hot numbers that were much more than expected. This, without those 2 hot numbers, would be a pretty good result. So I think you look at that, and that should ease your concern. That looks at the core of the economy, the business spending side and the consumer spending side. They're okay. And in fact, I would not be surprised or displeased to see them cool even a little bit more to get down and relieve some inflationary pressure that could potentially happen in the economy. As for the Fed, very quickly, I think the story is that they're going to wait and watch this. They're going to be very interested in how these numbers, as Greg said, parse out tomorrow. Do we have a January, February inflation problem, or is this also a March problem? That's something the Fed's going to want to see. But I think right now they're pretty firmly dug in with this idea that they have the right rate to bring inflation down, which means I don't think they feel as a committee they need to go higher here. So what this means is higher for longer. And it means that rate cuts are probably into the fall at this point. There's still a July possibility if we get some really good numbers, and Greg is right that we really had a lot of noise at the beginning of the year. But I would say that's a shrinking possibility. It's higher for longer. It's later rate cuts. But I think cuts are still a possibility here if what we're seeing is a lot of noise at the beginning of the year.
Greg, I'm going to give you the last word.
Yeah, I think Steve is absolutely right. We have to look at the underlying pace of growth. That still shows a relatively robust economy. Emily pointed out the fact that the labor market is the key pillar of economic activity. That's still sustained, but we are seeing evidence that we're still moving in the right direction in terms of disinflation. Policymakers will be much more cautious than we are as economists because they're working on a data-dependent policy play-by-play type of approach, which is a risky proposition in this environment. But they're likely to err on the side of caution and delay rate cuts until they are very sure that inflation is not about to reaccelerate. I don't think it will, but Fed policymakers will likely want to be a little bit more
Great and substantive conversation. Thank you very much, Greg Daco, Emily Roland, Steve Liesman. Appreciate it.